We just got off the Oracle conference call and have to say it was had a very positive tone to it. Oracle seeing a fair amount of growth coming from AI and is coming into the lower margin services business. We would expect that for the market to broaden out, everybody's going to have to benefit from AI. The market will need to broaden out for it to go higher. As we look out for the next, say, 12 months, we see the probability of a recession of being significantly high. No recession, I don't think that's a really high probability, but it's possible. If we have a modest recession, we see about 15% downside. And without a recession, the market will probably go up another 10% from where it is currently. So, thinking through this a little bit, what do we need to do from this point? And we thought it'd be good to review an asset allocation for investors and why it's so important. And investors that are not with me managing their money, they ought to think about incrementally getting more defensive as the market hits new highs, not new highs, but new highs for the last 52 weeks. The market's still down considerably from where it was. And then slowly kind of pull back on the risk exposure and then be ready to pull it back much quicker if the market begins to roll over and discount that recession coming. So if you, we'll look at this next chart. So this is how my strategies work. So as the market rolls over, gets a sell signal, we get defensive, we go sideways as the market falls. So that's basically what we did last year. We protected capital, the market fell. Now we're in a more recovery mode, but we're probably hitting the point where we're going to see some pretty stiff resistance in the overall stock market. So reviewing asset allocation. Now asset allocation is critical for returns in the long term. You can adjust your risk exposure, bring it down if you need to. And tactically, I think it's a really important thing to do at this point. We are getting up to the point where we are roughly 19 and a half times earnings. We might go in a recession next year, therefore the earnings are too high. The stock market may be about 5 or 6% overvalued at this point, given the work that we do. A typical asset allocation is 60% in equities, 40% bonds. As you know, if you were in that allocation last year, you probably lost somewhere between 15 and 20%. If your allocation of that 60% was in growth equities, you probably lost a lot more, as most growth managers were down close to 40% last year. Now, what concerns us most is technology is such a big part of the overall stock market now, the S&P 500. If you take the technology sector plus you add in the companies that should be in the technology sector, such as Google as an example, you get to about 40% of the S&P 500 that is technology related. 6 names are 26% of the S&P 500. So the market tends to have more volatility both on the upside and the downside. Just keep that in mind when you're thinking about owning the S&P 500. We would prefer investors look at the equal weighted S&P 500 rather than the market weighted S&P 500 here, because we think the market has got to broaden out and there's probably less downside in the equal weighted names versus the market weighted names. So looking at what the market's currently doing, the market is broadening out short term. So I know the month to date looks pretty good for small caps. We're up almost 7% month to date versus the Nasdaq and the S&P 500 less than 2. So there's been a movement to broaden out the overall market. The equal weights are up 4%. Now, these performance numbers are all from last Friday, so a little bit of a change on Monday. But you can see the market is trying to broaden out, and for good reason. Again, 19.5 times PE for 2023. That's high, given where interest rates are currently. So if you do the calculation of the 10-year Treasury at 375, the market's about 6.5% overvalued on that. But if you peel the onion back a little bit more, the average stock in the S&P is 15 times. That's reasonable. And then the smaller cap names are roughly 12 times earnings. So probably before the market quits going up, you're going to see a broadening in the overall stock market. So we'll have inflation coming out on Tuesday morning. The market's looking for roughly 4.2% year over year, and that's 0.2% month to month. So 4.2% year over year, that's down pretty significantly from 4.9. So we're seeing this nice trend here in the reported CPI coming down in a nice big way. Should probably continue. The core is a little sticky, so the core needs to start rolling over. That's what the Federal Reserve is looking at. Now, what Chairman Powell has done is he's in the process of really putting some pain on the economy. So if you go back here to 2006, 2007, so it took him, it took the previous Fed roughly 2 years to raise roughly 5%, 5.25%. And then it took another year before we actually entered into a recession. So we are up here. We're in the beginning part of probably seeing the economy starting to slow. And it could be another year before we go into a recession, maybe less because they've been so aggressive, but probably something like 6 to 12 months before we actually enter a recession. And this is a really good indicator for the economy, the inverted yield curve. So if the bond market was convinced that we weren't going into a recession, we wouldn't have an inverted yield curve, and therefore the stock market wouldn't be concentrated in only 6 names. It'd be a very broad move that would be occurring. But currently we have a very inverted yield curve. I would expect that perhaps when the Fed meets on Wednesday, announces they're not going to increase interest rates at this point, you might see the 10-year Treasury go up a little bit and the market to broaden out. If it doesn't, then I think we are definitely headed for a correction sooner rather than later. Again, I think it's really important to look at your holdings. The market is giving you a gift. It's saying go back and review what you own, because if you didn't like what happened last year, you could see a repeat. So it's just prudent to take some off the table currently. As the market continues, it'll give you a more clear sign when it actually starts to roll over. So be proactive, protect your money. So thank you very much. Click subscribe, hit like if you like it. And again, if you like Market in a Minute, we have a weekly research piece. We send it out to your email address, but you need to come onto my website, Patrick Adams CFA, and subscribe to it. Take care.